Hello everyone. We'll get going here in just a few minutes. Let's see here. Sorry, I'm trying to. Hey Paul, hey Jason. Let me give it another minute here, and we'll kind of get moving. Hey Henry. Well, it's hard to believe that we're down to the last three chapters in Intermediate 2. It's definitely flown by for me. I'm sure it has for you all as well. Hey Ryan. Um, just so y'all know, I have the slots. Last I checked, there were still a few slots available for individual meeting times on Friday. Again, if you tried to make an appointment and there wasn't one available, just let me know, and I'll try to open a few more up. Um, but we're kind of fast tracking towards the end of the summer semester here, so let's kind of get moving here on accounting for leases. Before I jump into it, depending on the version of the textbook that you have, the accounting standard for leases changed. I think it was 2016 or 17 is when it kind of finished, kind of got fully implemented. So if you have sort of the prior edition to the book or something like that, you probably have the old standard. So just make sure that you have the latest edition. Your e-text through Canvas definitely has the updated standard. And of course, that's what this lecture is going to be based on. All right, so a lease represents, we're just going to kind of set the background for what a lease is. So a lease represents a right of use that the lessee, which is the person using the asset, has for an asset that is owned by the lessor. That's the person who's allowing their asset to be leased in exchange for lease or rental payments. The right of use, which is this term we're going to use a lot, the right of use likely represents present control over the asset, a probable future economic benefit for the lessee, and it results from a past transaction or event. So the right of use is an asset under U.S. GAAP, and so and that's regardless of the classification of the lease. And so we have this right of use, and so we have an asset. At the same time, of course, we have this obligation to make these lease payments, and it's unavoidable. There's an economic sacrifice, and there's a past transaction or event. And so there's two sides to this transaction. There's the right of use asset, and then there's the lease liability. And so you have two of these things that simultaneously get created when the lease is signed. And then, of course, as we execute that lease, both of those items are going to change. Now, the methods that we use to change the items, that's where the classification is gonna matter. The initial signing of the lease, though, whether it's a finance lease or an operating lease, it doesn't really matter. And so just be aware of that. Under the new standard, this is the view that we take. All right, so leases do hold some advantages over purchasing an asset. First of all, for most leases, there's no money down, and so it is a form of 100% financing, whereas usually with a purchase, there is a fairly significant down payment. Leases do allow for a more convenient of replacement of an obsolescent item. So, as an example, a lot of businesses now will lease their computer equipment, and the reason they may do that is because they want to be able to replace it kind of conveniently every 2 or 3 years. And so it kind of always ensures that employees have the latest and greatest. And if you had purchased it, then of course you'd have the obligation to try to sell it and facilitate all that. And if I'm in the business of I don't know, like I'm a real estate developer or something like that. I'm in the business of developing real estate. I'm not in the business of selling computers. So Jason, you can. Typically with a lease, they don't require it though. I know sometimes with if you lease a car, they want the first payment up front, but it's not really a down payment. So what we're kind of talking about is I would think more like a house, because that's probably a better example. So if I go buy a house, odds are I'm going to have to put a down payment on that house, either 10 or 20%, sometimes more, depending on the nature of the real estate transaction. Whereas if I want to rent a house, I don't have to put in, I might have to put a deposit down, but I get that money back. It's not like I have to make a down payment. So that's kind of what we're more getting at. I know with cars, especially if you've leased a car, it's a little bit of a different animal. But this is kind of, I don't want to get into the nuances, but it's just typically speaking, there's no required down payment for a lease, or a lot of times you can negotiate not to have a down payment, where it's a little harder to do that with the purchase agreement. Um, Leases usually are more flexible. So with a lease, there can be a lot more variety in the way that you structure the lease agreement. Usually with agreements, it's with a purchase agreement, it's pretty straightforward. It's kind of either like a fully amortized loan or a cash payment for the full amount, whatever it might be. And so there's just less flexibility with purchase agreements. And then there may be cost or tax advantages. So this is kind of like, if they're depending on the way the lease is treated for tax purposes, the lessor a lot of times might have a higher tax rate. And so if they can keep the asset on their books, they get to record the depreciation and any like sort of larger costs associated with the asset. And so if they're able to do that, they basically get a larger tax benefit. And so usually that benefit is shared between the lessor and the lessee. So there's some there are some tax benefits to lease arrangements as well. All right, so who's the one that facilitates the leases? In other words, who's the person that usually is the lessor? So banks, they're the largest one by far. So usually it's a financing type arrangement, and the bank is going to be very efficient at doing this. And so they have access to funds, and of course those funds are used to purchase the assets from the seller. So the seller essentially sells the asset to the bank, and then the bank leases it to the lessee. And so that's why the lessor is the bank, not the original seller of the piece of equipment. Like with a car, if you go lease a car at a dealership, usually what ends up happening is there's a bank that actually finances that lease. And so what ends up happening is the dealer actually sells that car to the bank, and then the bank leases that car to you. And usually, you go back, you return the car to the same dealership. That's pretty typical. Usually with the agreement between the bank and the dealership they've pre-negotiated the repurchase price. And so basically the bank just kind of round trips it. They just finance it for the 3 years that you're in the lease, or whatever length of time it might be. But they're the ones that actually hold the asset during those 3 years. Banks also have economies of scale, so usually they can provide lower cost financing. And many leases, not all, but many leases are standardized, and so the bank can efficiently process those leases. Another large group of lessors is captive lease companies, and so usually this is like a subsidiary of a large company. So like as examples, Ford, Caterpillar, and IBM, they all have captive lease companies, and so these are just large organizations that handle the financing of leases. And with a company like Ford or Caterpillar or IBM, they're big enough where they can still get those economies of scale. But of course, Ford's not going to facilitate the lease of a brand new, Cadillac or something like that. So they are definitely smaller than banks as far as if you talk about the lease market, but they're pretty considerable. So car salesmen would report revenue. Yes, Harry, they would. So at the time of the lease agreement, that's when the dealership would record the revenue, and then when it comes back, they'd obviously have to complete that transaction. Yes, essentially, Ryan, that's right. A captive lease company is in-house financing. Yep. So usually just large organizations are going to have that. I think Dell has a captive lease company as well. And then there are some small independent lessors. They're very, very small, and that's usually like if there's some sort of specialized lease arrangement. Those usually are fairly high cost. So just be aware of that. They exist, but they're not a major player. All right, so The latest guidance under US GAAP requires that all long-term leases are capitalized. Basically, anything past a year, that must be capitalized. And so that agreement then creates a right-of-use asset, which we talked about, and the lease liability for the lessee. So again, regardless of the specific characteristics of the lease, if the lease is more than a year, then it must be capitalized. We're going to talk about how we do that. So there is a difference, though, in the two classifications. There are finance leases and there are operating leases. And those two classifications do determine the type and timing of expenses under the lease arrangement. I want to be clear, though, the classification does not determine the total amount of lease expenses. And so we're going to get into the details of this. And so essentially at the end of the day, the expenses related to the lease are the same regardless of the classification. But the classification may change the way we classify those expenses and the timing of those expenses. So that's really the difference. It's not total expense, it's timing and type. All right, so there are two. The finance lease, which we've already kind of mentioned these two types of leases. So finance leases, this is where the lessee is going to report interest expense using the effective interest method. So basically with the lease liability, we're going to amortize that lease liability like we would any other debt, and they're going to record an interest expense related to that. If on the other part of the transaction is the right of use asset, in this case the lessee is going to report amortization expense for the right of use asset. I want to be very clear, it's amortization expense. And usually they're going to use what's called a straight line method. This amortization expense is calculated very similar to the way we would have calculated depreciation expense. And actually you can actually amortize it using essentially any of the depreciation methods. But typically companies use a straight line method when it comes to leased right of use assets under a lease arrangement. Again, I want to be very clear though, it is amortization expense. A very common mistake that I see with students is they call it depreciation expense, but it's not depreciation, it is amortization. So you amortize a right of use asset. And then the other classification is an operating lease. With this one, there's just a lease expense. And that lease expense is even over the life of the lease. So just expense, sort of like you would, every month, lease expense, lease expense, lease expense. Of course, in this class, we're going to accrue it either with the payment or an end of a fiscal year, but it's evenly distributed throughout the life of the lease. The company actually still amortizes the lease liability following the effective interest method, but the amortization of the right of use asset follows this thing called a lease expense schedule. Now the lease expense schedule basically reconciles three different things. The lease expense schedule allows the lease expense to be even over the life of the lease. It simultaneously allows the cash payments to be recorded correctly, and finally it allows the lease liability to be amortized using the effective interest method. So essentially that lease expense schedule is a plug. It's something that makes it work. This treatment of the asset, the right of use asset, is probably the most controversial under the new standard because quite honestly it doesn't follow in any sort of logic. It's just sort of something that makes the standard work. And so most students struggle understanding why we're doing what we're doing with the lease expense schedule, and it makes sense because there's really no sense to it. It's just, hey, this is what makes the whole thing work. Is that, the amortization? Yes. I mean, it's really the distinction. I'm assuming you're back to that question. I'm sorry, I didn't quite see it right away. But yes, essentially amortization of a right of use asset is different than depreciation, and a big distinction obviously is because with a normal asset that you depreciate, you own the asset, but in this case of course you don't. I will say under the old standard they used to call it depreciation expense, and so I think that is a source of some confusion. Alright, so let's talk about the guidelines. So under the current guidance, US GAAP no longer applies bright line criteria to classifying leases. And so under the old standard, it was basically there's rules. If you violate a rule, it's a capital lease. If it's not, then it's an operating lease. And so we've done away with that term capital lease because we capitalize all leases. And also we have rules that serve as guidelines. Again, there are 5, but they are not bright line rules. And so although in practice the guidelines are generally applied as rules, but they aren't explicitly rules. So I just want to be very clear. These are guidelines, not rules. For this class, though, we're going to treat them as rules. In other words, if I'm asking you to figure out whether you have a capital or a finance lease, you need to make sure that you follow these rules and know these rules. And again, these are guidelines, but you're going to apply them as rules for this class. But in practice, it's a little bit different. All right, we're going to use the criteria to determine if it's a finance lease. Again, before considering each criterion, the lease must be non-cancelable. So that's just sort of an underwriter. So if the lease is cancelable, then all this goes out the window, and it's treated very differently anyway. If the lease is cancelable, then it's just going to be an operating lease, and so you don't have the rules in that case. All right, let's talk about the first of these guidelines, and it's called the Transfer of Ownership Guideline. So if the ownership of the right-of-use asset transfers to the lessee at the end of the lease, then it should be treated as a finance lease. And so within the contract, if there is a transfer of the asset at the end of the lease to the lessee, then it should be treated as a finance lease. The second guideline is the purchasing option. If it is reasonably certain the lessee will exercise a purchase option at the end of the lease, then the lease should be treated as a finance lease. So if the lease has some sort of agreement that the lessee can purchase the asset at the end of the lease, if it's reasonably certain that they will, then it should be treated as a finance lease. And so, of course, what does it mean to be reasonably certain? And so in practice, the way we apply that is if the option price is substantially below the projected residual value, then it is reasonably certain. So sometimes this is called a bargain purchase price. And so let's say that when the company signs a lease, they project that the asset is going to be worth, let's say, $15,000 at the end of the lease. And let's say that they have an option to purchase the asset for $1,000 at the end of the lease. Well, that $1,000 option is substantially below the projected residual value of the asset, so it is reasonably certain that the lessee is going to exercise that option, and therefore it should be a finance lease. Now let's say that the price, same $15,000 projected value, but let's say that the price is $14,000. Well, in that case, it's really not certain that it's substantially below, and so I would not say that it's reasonably certain in that case. And so for the purchasing option, for that particular case, I would not say that the purchasing option triggers a finance lease. Again, there is some judgment, though. We are going to be going through No, there's no guidelines. It's just the substantially below. That is literally how the standard reads, substantially below. So a lot of judgment there, a lot of judgment. All right, so the next test is what's called the lease term test. Sometimes it's known as the 75% test. So if the lease term is 75% or more of the estimated remaining useful life of the right-of-use asset, then it should be treated as a finance lease. All right, so let's say that the remaining useful life on an asset is 4 years, and I sign a lease term for 3 years. Well, in that case, I've reached this 75% test, and the guideline would suggest that that should be a finance lease. If, let's say, there's 10 years left, and I sign a 4-year lease, then this would not trigger a finance lease. Again, it doesn't mean that it's not. It just means that this specific test would not trigger a finance lease. Again, these are guidelines, not rules, but again, in this class, we're going to treat them as rules. So how do you handle renewal options? And so if you, let's say you sign a lease and it has, 1-year lease with 5 renewal options for each year after that. This is kind of back to this reasonably certain standard. And so if it's reasonably certain that the lessee is going to exercise the renewal option, in other words, if it's a bargain, then the renewal period must be included in the lease life. If it's not a bargain or if it's not reasonably certain, then you do not need to include the renewal period to determine whether or not you have an operating or a finance lease. There also could be challenges in assessing the remaining useful life of an asset, but usually that can be fairly readily known. Again, we're just sort of giving you all the little nuances that you have to deal with. For the purposes of any test or class, question, I'll be very clear. But just know in practice, as you're already probably sensing, there's a lot of squishiness in applying this standard. All right, so present value test, this is where we're going to spend most of our time. So the present value test, also known as the 90% test. So if the present value of the minimum lease payments equals or exceeds 90% of the fair value of the right of use asset, then it should be treated as a finance lease. Again, we have to determine sort of what the minimum lease payments are, and then we need to figure out how to calculate a discount rate. And in this case, we're going to use this term implicit discount rate, and I'm going to kind of demonstrate to you how to calculate that implicit discount rate. But again, you get the present value of the minimum lease payments, and you compare that to the fair value of the asset. If it's 90% or more, then it should be treated as a finance lease. All right, so let's talk about what we mean by minimum lease payments first. So minimum lease payments are going to include any fixed payments that are part of the contractual lease agreement, any variable payments that are based on an index or rate when that index or rate is known, any amounts that are guaranteed by the lessee under what's called a residual value agreement. And a residual value agreement essentially means that the lessee can guarantee that the asset will be worth a certain amount at the end of a lease. If they've made that guarantee, then it would be considered part of our minimum lease payments. Another part of the minimum lease payment would be any purchase or termination options that are reasonably certain to be exercised at the end of the lease. So as an example, let's say that I have an obligation to buy the asset at the end of the lease for $5,000. Well, that would be included in the minimum lease payments. Or let's say that I have to pay $1,000 fee if I don't renew at the end of the lease. Well, that would be included as a minimum lease payment. So again, all these things, there's judgment. I'm going to make it fairly clear, not fairly, I'm going to make it clear in how to apply the standard for each situation that you're going to face. But no, in practice, there's a lot more judgment, and it can get really difficult to apply the standard consistently. The second thing we have to talk about is the discount rate. So the lessee should use what's called the implicit rate in the lease. And what the implicit rate is that's the lessor's rate of return. And so you essentially adopt the lessor's perspective, think about the lessor's cash flows, and then calculate a rate of return for the lessor. And that is the rate that's used then in the lease. If the implicit rate cannot be determined, then the lessee may use what's called its incremental borrowing rate. And basically what they do is they kind of estimate how much would it cost us to borrow the money to buy this asset. And so that rate obviously is not known, but they probably can make a reasonable estimate of that. Again, you use the implicit rate unless that implicit rate cannot be known. If it cannot be known, then you can use what's called the incremental borrowing rate. So you can see there's judgment there as well on what to do in terms of the discount rate. Okay. The final test is what's called the alternative use test. So if at the end of the lease term the lessor does not have an alternative use for the asset, then it should be treated as a finance lease. And what do we mean by that? Well, that means if when the asset goes back to the lessor, if it's essentially worthless, then it should be a finance lease. If he can sell it, or if he can release it, or whatever, if there's something else that he can do with it, then you don't necessarily have to treat this as a finance lease. But if the asset is useless, then it should be treated as a finance lease. All right, so let's talk about this present value calculation, because that's probably the piece of this that's the most difficult to apply. So the step one in doing a present value calculation is you do need to determine the implicit rate in the lease. So again, you have to understand the economic flows of the lease from the lessor's perspective. So again, you need to adopt the lessor's perspective in order to understand what the lessor is expecting to receive in terms of a rate of return. Okay, so thinking of the present value calculation using our time value of money calculator, I've kind of laid it out. And essentially what we're doing is we're solving for the I/Y from the lessor's perspective. So in other words, we now need to be able to determine the N, the PV, the payment, and the FV. And so we're going to use the terms of the contract and other information to determine those items. After we're able to do that, then we calculate the present value of the minimum lease payments. And so essentially now you've calculated the discount rate, then you flip from the lessor's perspective to the lessee's perspective. And so now we're going to adopt the lessee's perspective, and now we're going to be solving for the present value of the minimum lease payments. So now we have the n, that hasn't changed. We have an I/Y now. We just calculated that. The payments likely are the same as the first calculation. The FV very likely is different, actually. And we'll talk about why that's the case. But essentially, we have to now recalculate everything from the lessee's perspective and think about the economic flows and obligations that they have from their perspective. All right, so let's kind of do one example here, or let's kind of start with an example of how to do a present value calculation. So 49er Company signs the lease on January 1st, 2020. The lease calls for 4 semi-annual payments of $20,000. The first payment is due on June 30th, 2020. The fair value of the right-of-use asset is $75,000 when the lease is signed. The estimated residual value of the asset is $10,000, and 49er has guaranteed $6,000 of this residual value. What is the present value of the lease? And so you might be asking yourself, do I need to be able to read something like this and calculate a present value on the test? Absolutely, you do. Now, it's not going to be. It's going to be. There's going to be one or two of these. There's not going to be 20 of these. But you do need to be able to calculate a present value. All right, so step one, of course, is calculate the implicit rate. And so again, using this information, we're trying to solve for the I/Y from the lessor's perspective. Again, we're adopting the lessor's perspective. And so from the lessor's perspective, there are 4 semi-annual periods that are part of this lease agreement. That's fairly straightforward. Now the PV, notice that what we're doing is we're putting in a negative 75,000. What am I communicating by putting a negative 75,000? Well, essentially that lessor is foregoing the use of that asset. And so if the market value of that asset, or the fair value of the asset, is $75,000, essentially by allowing the lessee to use it, they're foregoing selling it for $75,000. And so from an economic flow, from their perspective, they're giving up a $75,000 asset at the beginning of the lease. But of course, in return, they're getting cash, right? So they're getting those $20,000 cash payments, and they're also getting the asset back at the end of the lease. And they believe that the asset is going to be worth $10,000. And so in total, if you think about it, they're getting, 4 $20,000 payments, that's $80,000. And they're getting an asset back that they believe is going to be worth $10,000. So in total, they're getting cash or economic flows of $90,000, and they're giving up the asset initially for $75,000. And so there's this exchange that the lessor is making. You got to figure out, well, based on the timing and the amount of these economic flows, what's the implicit rate of return? And so you put all that information into your time value of money calculator, and then you solve for your I/Y. And you can see they're getting a semi-annual rate of return of 7.21%. Now, the reason I know that's a semi-annual rate of return is because the payments are semi-annual. So as soon as the periods are in a semi-annual format, then the I/Y that you solve for is also going to be in a semi-annual format. So again, this is just giving you the semi-annual rate of return. So really they're getting, almost a 14.5% rate of return on this lease, which is, maybe high, but we don't know what kind of risks are involved in this lease arrangement. All right, does that make sense? I want to make sure I just kind of stop there and make sure everybody understands how to get to that implicit rate. Because if you can't get to the implicit rate, the rest of the problem is pretty difficult. Good. All right, sweet. All right. So the second step then is to calculate the present value of the minimum lease payments. Again, we just calculated the implicit rate. Step 2 then is to calculate the present value of the minimum lease payments. And so again, from this now we're adopting the lessee's perspective, and we're calculating the present value. And so the N and the I/Y are the same. It's still 4 semi-annual periods. We just calculated the semi-annual implicit rate in the lease, so we're using that 7.21%. From the lessee's perspective, they are making $20,000 payments, and so that's a negative cash flow from their perspective. And the FV, instead of being 10,000, they're only required to basically guarantee $6,000. So from their perspective, they have this economic obligation at the end of the lease of $6,000. And so that's why we have the negative $6,000 as the FV. Remember, with the lessor, that number was 10,000 because from the lessor's perspective, they're getting an asset that they believe is going to be worth $10,000. From the lessee's perspective, we're more concerned about their obligations. And so their only obligation related to the end of the lease is that $6,000 guaranteed residual value, which is why we have a negative $6,000. So then we take that information and we solve for the present value, and we get $71,972. So again, I hope you're able to do that. Obviously, that's a critical calculation for doing lease accounting. All right, now since the $71,972 is more than 90% of the $75,000, this would be a finance lease. Regardless of any other terms, as soon as you go over 90%, that guideline indicates that this should be a finance lease. And again, for this class, we're going to use that more as a bright line rule. So this would be a finance lease. Ryan. I'm guessing rounding on the I/Y. That's my best guess. All right. Present value example number 2. So 49er Company signs a lease on January 1st, 2020. The lease calls for monthly payments for the next 60 months of $750. The first payment is due immediately. The fair value of the right-of-use asset is $50,000 when the lease is signed, and the estimated residual value is $20,000, and 49er has not guaranteed any of that. So what is the present value of the lease? Again, we need to calculate the implicit rate first. So we're going to be solving for the I/Y. So let's kind of lay things out here. Now, there is a little difference though, in that it says that the first payment is due immediately. So this is a beginning of the period payment situation. Now the nice thing is you can tell your calculator that you're in that situation. And so if you remember with your TVM calculator, we have our 5 buttons. The default setting on your calculator is that every cash payment or cash flow is at the end of a period. That's the assumption in the calculator. And so if you have a situation where the payment is at the beginning of the period, you need to change the calculator's assumption. And the way that you change the calculator assumption is if you notice above the payment button, there is a BGN, a little BGN. And what that's telling it is if I set my calculator correctly, I can tell it, hey, payments are happening at the beginning of each period. And so the way you change that is you hit your second button, and then you hit that payment, which is the BGN, and you notice that right now it says end. It should say end on your calculator right now. If I want to change that, I hit the second button again, and I hit enter. And now it says BGN. So it's to change the setting, it's second payment, second enter, second payment, second enter, second payment, second enter. And so as soon as it says that, then I just clear everything out. And notice that above about the second number place, there's a little BGN. And that basically tells you that you are in BGN mode at this point in time. In order to calculate it correctly, you need to be in BGN mode for this kind of a problem. And I'm going to give you all a second, so just give me a thumbs up or you got it if you are able to get your calculator in the BGN mode. So enter is the second button at the top. It's right up there. So Harry, were you able to find it? Sweet. All right. So now that we have the settings correct, Now let's start filling in the information. And so hopefully from the problem it's obvious that there are 60 monthly payments. We're solving for the implicit rate. From the lessor's perspective, they're giving up that asset today, so that's a negative flow of $50,000. Of course, they're going to receive payments of $750, and they're getting the asset back for $20,000 at the end. And so their monthly, again, this is a monthly implicit rate, is 0.7%. And so their monthly implicit rate is 0.7%. So that's the rate of return, the monthly rate of return on this lease from the lessor's perspective. All right, now we need to take the next step, and that is to now calculate the present value of the minimum lease payments. So again, now we're solving for the PV from the lessee's perspective, the PV from the lessee's perspective. So the N and the I/Y are the same. 60 monthly payments, 0.7% discount rate, and that stays in the BGN mode. All that stays the same. From the lessee's perspective, they're making a payment now, so it's negative $750. But in this case, the lessee has not guaranteed anything, and so the FV from the lessee's perspective is zero because they're under no obligation at the end of this lease. They just turn the thing back in. And so when we solve for the present value, we get $36,865, and in this case that's less than 90% of $50,000. And so according to this test, this would be an operating lease. Now we don't have all the other information, because we could have this 60 months could be 75% or more of the remaining useful life of the asset. We're not told that, and on a test I would make it clear, but I just want you to be aware that we're just isolating that 90% test at this point. And so according to that test, this would not be a finance lease. This would actually be an operating lease. Again, I hope everybody's able to get to the present value. If you have, again, another quick thumbs up just to let me know that I can move on. All right. Sweet. Okay. So now let's take this example problem. And of course, we're filling the screen with words, right? So, I would say like on the tests, it's not quite this wordy. I have the kind of smaller problems, and so just be aware. I'm kind of throwing everything in here and kind of trying to just do one comprehensive problem. When I do the in-class version of this, I actually have a problem like this on the exam. So in some ways, the online version is probably a little easier, but of course there are other challenges with online tests too. So, all right, so let's talk about this lease. So 49er Company leases a fleet of trucks from Ford Motor Company through Ford Motor Credit. The lease is signed on October 1st, 2020. There are 5 annual payments of $85,000 with the first payment due September 30th, 2021. So already, hopefully you can see that this is an end of period payment, not a beginning of the period payment. And so if I were you, I would go ahead and change it back, and actually that's what I'm going to do right now. So again, second payment, second enter, and you should have it changed back to end. So I would just make that change right away. With every problem, make sure your calculator is set up correctly first and foremost. So anyways, the fair value of the trucks is $350,000 when the lease is signed, and they have a useful life of 6 years. So already, because it's a 5-year lease and it's a 6-year useful life, we've already gone over the 75% rule, so this is already a finance lease. Regardless of what we do with the present value calculation, we already know this is going to be a finance lease. And then there's a believed there's going to be residual value. 49er Company is guaranteed $15,000 of it. There's no transfer of ownership. There's no option to purchase, and there is an alternative use at the end of the agreement. So let's go through these journal entries for the first 2 years, and then for the last bit of this situation. All right. So we do need to evaluate the 5 criteria. And so, the first 2, there's no transfer of ownership. There's no purchase option. So those two would not in and of themselves trigger a finance lease. The lease life does. We already said that. And then we're going to figure out the present value, whether it would have. And then the alternative use also would suggest that it would not suggest that it has to be a finance type lease. And so we know that we have a finance lease because of the lease life, but we're also going to do the present value calculation. First of all, regardless of whether it's a finance or operating lease, we need to do the present value calculation. Second of all, it just gives us some extra practice to understand how to apply the present value test. And by the way, on a test, if any one of these things triggers a finance lease, then it should be classified as a finance lease. All right, so when we do the present value test, the first calculation is to calculate the implicit rate in the lease. Again, this is a 5-year lease. The assets, the fleet of trucks is worth $350,000 when the lease is signed. They're going to receive $85,000 payments, and they believe the trucks will be worth $50,000 when they get them back. And so we put the information into our calculator, and we calculate an implicit rate, and in this case, because they are annual payments, this is the annual implicit rate of 10.34%. So I'm hoping that makes sense. So again, 10.34%. So then the second step then is to calculate the present value of the minimum lease payments, and that's now from the lessee's perspective. A lot of the information is the same. So as an example, the n is still 5, the I/y is still 10.34, which we just solved for. Now the payments flip in sign. So before it was positive 85,000, now of course it's negative 85,000 because from the lessee's perspective they're making the payments. The other difference is the asset is thought to be worth $50,000 when it's returned, and so from the lessor's perspective there's an economic flow of $50,000 at the end of the lease. But from the lessee's perspective, they've only guaranteed $15,000, and so their obligation is limited to $15,000, and so that is going to change the present value calculation a little bit. And so when we do the present value calculation, we get a present value of $328,601, and in this case, that amount is still more than 90% of the fair value of the right of use asset. So even if the lease life had not triggered a finance lease, this present value calculation would have triggered a finance lease. So we're clearly in finance lease territory here. Okay, so the two things, again, just to remind you, the two things we have to do is we have to amortize the lease liability using the effective interest method, and we have to amortize the right of use asset using a straight line method. And so we're going to start with the lease liability. You've seen amortization tables before. This one's a little bit different, but it's largely the same as everything you've seen. And so initially, of course, we signed the lease on October 1st, 2020. The initial carrying value of the lease liability is that present value of $328,601. So that's how we start. We assign that present value of the minimum lease payments as the initial carrying value of the lease liability. And so from there, we start the amortization process. Now, notice that again, just like we did before with amortization tables, we ignore fiscal year ends. They're important for journal entries, but they aren't important for the amortization process. And so really the next thing is, that next year on September 30th, 2021, with that payment, again, with the payment then, we have the $85,000 payment. We calculate the interest expense using the implicit rate, and we apply the implicit rate to the prior carrying value. And so that's where the $33,980 came from, 10.34% times $328,601. And of course then the difference is the amortization, and so the amortization reduces the carrying value of the lease liability. And now one thing I want to think about, I just want to remind you, when you talk about a present value calculation and an amortization process, I'm going to go back to the TVM. So what amortization does is it takes you from the present value to the future value. So we're going from $328,601 to $15,000. So that's what the TVM does. It takes you from the PV to the FV. And so with this amortization table, we're starting with the PV and we're going to end up with the FV. And so whenever you're doing these amortization tables, that's what you should look for. That's what should be happening. And so again, the process of amortization is exactly the same every year. You take that implicit rate, apply it to the previous carrying value. The difference between the payment and the interest expense is the amortization, and the amortization reduces the carrying value of the liability till at the end of the lease, the carrying value of the liability is $15,000, which is the residual value and the FV in our TVM calculation. So again, we have to understand how to do one of these. You're going to have to be able to do these calculations on the test. All right, so now with the amortization of the right-of-use asset. So what I've given you here is the equation that we use for the amortization expense. So we start with the present value of the minimum lease payments. We subtract any residual value in the lease, and so that FV amount. In this case, that residual value was $15,000, and then we divide that over the lease life. Now, there are all alternatives to the denominator. We're not going to focus too much on them, but I want you to be aware that the denominator can change depending on some of the contract stipulations. So I just want you to be aware of that. Sure. There you go, Paul. Now I forget, is the amortization table in your notes? Paul, you're okay. Good. All right. All right. So given this situation, we have the present value of the minimum lease payments. That's $328,601. We have the residual value of $15,000, and we have the lease life, which is 5 years. And so the amortization expense is $62,720 per year. Again, we're using the straight line method. That's the only method we're going to use for this class. But there are other methods for amortization, like you can do double declining balance or sum of years digits or whatever. But in this case, we're just going to do straight line. So then let's start with the journal entries that we're going to have in 2020. At the inception of the lease, you debit the right-of-use asset, in this case it's a piece of equipment, and you credit the lease liability for the present value of the minimum lease payments. And so that is the initial journal entry. So we bring everything on to the books at the present value of the minimum lease payment, and the right-of-use asset and the lease liability are brought on for the exact same amount. So for that initial journal entry, it will always look like this. Obviously, the amount of the debit or credit would be different, but we're always going to be debiting that right-of-use asset, and we're going to be crediting the lease liability. So then at the end of 2020, we come to December 31st. Now, on December 31st, there's a lot of things going on that we need to pay attention to. First of all, we have been amortizing the lease liability and incurring interest expense related to that lease liability since October 1st, 2020. So there's been 2 months of that process going on. We've also been amortizing the right-of-use asset. Now, of course, we haven't recorded any of this, but the interest expense is incurred continuously. The amortization expense is incurred continuously. And so we're going to record those items periodically. Again, incurred continuously, recorded periodically. And so on December 31st, 2020, we need to make these adjusting entries to account for the interest expense that's been incurred and the amortization expense that's been incurred. All right, so now we're going to focus first on the accruing that interest expense. And so 9/30/2021, we have the payment, the interest expense, the amortization, the carrying value of the lease liability. So these items are all things that culminate on September 30th, 2021. So it's the 12 months that end September 30th, 2021. And so this is the line that's relevant for any adjusting entry on 12/31/2020, because 2 months of this line occur in 2020. And so the accrued interest then is the full amount, which is the $33,980 from that row, multiplied by 3/12, because you have October, November, and December. So you have 3 months of interest expense that's been accrued. I think I just said 2 months actually, but it's 3 months have been accrued in 2020. And so we need to accrue $8,495 of interest. And so that is the interest expense. Now this is the feature in this process that some students really struggle with. So I'm gonna kind of talk you through why we credit the lease liability. So we have incurred a lease expense on paper, right? So that's this process of amortization. Now the question is, okay, given that I've incurred an interest expense, but I have not paid that expense, where do I put the offsetting credit? A lot of times you might want to think interest payable would be a good candidate. Well, the only issue with interest payable is that interest payable really is meant to capture a contractual obligation to pay interest. But in this case, we really don't have a contractual obligation to pay interest because that's not how the contract is written. Now, we do have a contractual obligation to make lease payments. And so what we do is we accrue that interest expense to the lease liability account. And so it actually temporarily increases in balance. And so it goes from $328,601 to whatever that is, $337,000 and some change. And so we actually increase the balance in our lease liability account. So we accrue the interest expense to the lease liability account. That is how we handle this accounting for the lease. And it makes sense because there's no contractual obligation to pay interest. The only obligation related to this lease is the lease liability. And so that's why we accrue it to that account. The second adjusting entry is the amortization expense related to the right-of-use asset. Again, the annual amortization is $62,720. Of course, 3 months have passed in this current year, and so that means we need to record amortization expense of $15,680, 3/12 of the annual amount. And so again, we have the amortization expense as the debit, and the amortization goes as a direct reduction to the right-of-use equipment account. And so there's no accumulated amortization or anything like that. It's kind of like with intangible assets. Whenever we amortize them, we directly reduce the account balance, and that's the same thing that we do with the right-of-use asset. The amortization expense is a direct reduction to the asset account. And so these are the two adjusting entries that are required at the end of 2020. I'm going to stop there for a second in case anybody has a question. All right, how's everybody doing? We good? Just give me again thumbs up. Yeah, Harry, I would say they want us to think of them differently than property, plant, and equipment for sure. But it's not quite intangible either because you have the whole lease liability thing going on. But I think they definitely want us to make a distinction between property, plant, equipment, and leased assets because they are really different animals. Okay? So let's talk about what we would see on our financial statements. The 62, that comes from this calculation right here. So we calculated the amortization expense for the right-of-use asset. So it's just the present value minus the residual value over the lease life, which gave us an annual amortization of $62,720. All right, so on our financial statements, we would report the right-of-use piece of equipment and the balance, and also we'd report the lease liability. And the lease liability, they actually break up into a current and non-current portion. I'm going to tell you right now, this is not on the test. All right, I just wanted you to kind of, so this is probably the second time I've taught this, trying to have you understand financial statement effects. Because I haven't really perfected the way I'm teaching it, I'm not testing it yet. At some point in the future I might. I'm just not quite there yet. So we'll see. Hopefully this time I'm better at it than I was the first time, and next time I'll be better at it again. But again, one challenge in intermediate 2 is trying to understand how do we take what we see in journal entries and how do we translate them to our financial statements. We did that a little bit in the investments chapter, and my goal at some point is to extend that to the lease chapter, because I think that's another great way to think about it. But there are 3 items on the balance sheet. There's the right of use piece of equipment, and then there's the lease liability, which they break up actually into a current and non-current portion. And so the right of use piece of equipment is that initial carrying value minus any cumulative amortization. So in this case, the only amortization has been from 2020, which is $15,000. Yes, Samantha. I think I may have talked about it a little bit before, but not as clearly I think as I'm going to now. Again, this is not testable though, so some of you are probably like, okay, just whoop. But I'm hoping it's of interest to some of you to see how this actually gets reported. So the right of use equipment would be reported at its new sort of amortized cost, which is $312,921. The lease liability is a little harder piece to figure out. Okay, so let me walk you through this. So the way that under the current standard, the way that we calculate the current portion of the lease liability is you take the balance that would be reported on 12/31/2020, so the total balance in the lease liability, and you subtract the balance that would be reported, or the total balance that would be reported on December 31st, 2021. So it's just that difference. It's the amount of that lease liability is going to be reduced in the next year. That's the current portion. How much will the lease liability be reduced in the next year? All right, well, let's talk about that. Well, the 12/31/2020 balance is the initial balance, which is the $328,601, plus the accrued interest from the December 31st adjusting entry. So the total balance is $337,096. Now let's talk about the balance from 12/31/2021. It would be the balance from the amortization table on 9/30/2021 plus any amount of accrued interest that we would record at the end of 2021, kind of similarly to the way we would calculate the 2020 balance. And so we take the amounts essentially from the table. So the table shows us that the 9/30/2021 balance would be $277,581, and then we add the amount of accrued interest, which can be calculated using the table's interest expense times 3/12. Again, this is where it gets really complicated, which is why I've always been hesitant to test students on this. But in total, the total balance in our lease liability account at the end of 2021 would be $284,757. And so what does that mean? That means that the current portion is the difference between those two. The $337.96 minus $284,757. So the total current portion would be $52,339, which means the non-current portion would be the 12/31/2021 balance. That went the wrong way. The $284,757, which is at the bottom there, near the bottom. So the current portion is the difference between the two, and the non-current portion is just the 12/31/2021 balance, which is $284,757. So this is actually how the company would report its lease liabilities on its financial statements. Again, a little complicated, not testable, but I wanted to walk you through it. So if you want to really learn this, you can go more slowly through it on your own later. And of course, there are 2 expenses. The amount reported is just the adjusting entry amount from each of these 2 items. That one's fairly easy. 2021 gets a little more complicated. All right, so now let's fast forward to September 30th, 2021, and we need to record the lease payment journal entry. The interest expense is the difference between the full year, which would be $33,980, minus what we had previously accrued, the $8,495, which means there's a remaining interest expense of $25,485. The lease liability account, so there's 2 components to this, and I'm going to go back to the table in a second to show you where they came from. But notice the 2 components are the $51,020 plus $8,495. Now remember that $8,495, that was the amount that we had accrued to the lease liability account at the end of 2020. So where does the $51,020 come from? Well, that comes from the 9/30/2021 amount of amortization. So notice where the $51,020 is right there on 9/30/2021, and it's the amount of amortization that we would have recorded from the table. And so the total journal entry amount for the lease liability is the amortization plus any interest that we had accrued to that account. And so the total entry amount is $59,515. And then the cash payment is $85,000, which is that contractual obligation. Now, we could have plugged in the lease liability number, but I wanted us to also understand where that number came from. So given the interest expense and the payment, we know how much we needed to reduce the lease liability by, but I wanted you to also understand where that number came from mechanically. I'm going to just pause there for 1 second because students typically have a question about that. I just want to make sure we're all good. The second piece, the $8,495. That was the amount of interest expense that we had accrued to the lease liability on December 31st, 2020. So I can go all the way back to the journal entry. It won't take long. So notice this journal entry here. We had accrued $8,495 to the lease liability. So now the amortization, or the full reduction to the lease liability, we need to get rid of that $8,495 plus the amortization from the table, the $51,020. I'm quite certain, Harry, you weren't the only one that wasn't sure where all those numbers came from. Okay, so now we're moving on to get the adjusting entries for the end of 2021. It's a similar process that we had just done, but of course now we're using the 12 months ended September 30th, 2022. So similar to what we had done before, we need to accrue interest. We take the full amount, the $28,704 from that interest expense column, the $28,704, and understand that between September 30th, 2022 and December 31st, between September 30th, 2021 and December 31st, 2021, we need to accrue 3 months interest. So we take $28,704, multiply it by 3/12, and that's where we get $7,176 in interest expense. And just like we had done previously, we accrue that amount to the lease liability account because that is the only liability associated with this lease. And the second piece then is the amortization expense, but in this year there's a full year of amortization. So our amortization expense is for the full $62,720, and of course that full amount goes as a reduction to the right of use asset, the right of use equipment. Okay, I'm hoping the second year was a little easier than the first year. Now let's go all the way to the end of the lease. So on 9/30/2025, there would be a remaining amount of interest expense to accrue. And so we can see that the interest expense for the 12 months ending September 30th, 2025 would be $9,372. We would have previously accrued 3 months of that interest expense, and so that means the remaining interest expense would be 9/12 of the full year's amount for $7,029. This is where you really have to use your imagination on the next one. So we have to also now think about what's going on with the lease liability. The amortization on 9/30/2025 is that $75,628, so that's part of it. But we also have to understand that we had partially accrued the interest expense to the lease liability account. In fact, we had accrued 3 months of that interest expense to the lease liability account. So there's two components to this. There's the $75,628, and there's the partial interest expense that we had accrued to the lease liability account. And so the total amount that we would need to enter for the lease liability is $77,971. I'm going to stop there for 1 second, because this is the one I think students typically are like, whoa, 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 where did that number come from? So I want to stop and allow you to digest it, but also give you an opportunity to ask a question if there's a piece of this that you're not understanding. Again, just giving you a minute here. So far, no questions, but I feel like about the time I move on, I'm going to get one. We'll see. All right. And then, of course, we have the cash payment of $85,000. Again, the amortization, or the entry amount for the lease liability could be derived from the other two items. But again, I want us to understand where that number came from. Of course, we still need to partially amortize our right-of-use piece of equipment because there are 9 months since the last time that we had recorded anything, and so we need to record our amortization expense for 9 months, which goes as a direct reduction to our right-of-use piece of equipment. And then the final entry, and this is something we have to think about, is if we go back to our original, I'll just use the amortization table. Notice that we still have a balance at the end of this, which means there's still a carrying value associated with that liability. Similarly, if you remember with the right-of-use asset, the amortization had a residual value, so there's a $15,000 residual value, which means at the end of the lease, there is an account balance for the lease liability, and there is an account balance for the right-of-use piece of equipment. And so we need to take both of those items off of our books at the end of the lease, because that asset is being returned to the lessor. And so that's why then we would debit the remaining balance on the lease liability and credit the remaining balance on the right-of-use piece of equipment. And by the way, those amounts will always be the same. The only thing that could happen is if there was like a penalty or something like that, there might be a loss. But in this case, in this class, we're going to keep it fairly simple. Okay. All right, now let's walk through an operating lease. So a firm leases a piece of equipment on March 1st, 2020. The equipment has a fair value of $215,000. Lease calls for 4 semi-annual payments of $18,000 on March 1st and September 1st of each semi-annual period, starting immediately. So you see that we're now in a beginning of the period type of situation. So again, what I would do is I would change my settings right now. Second payment, second enter. Make sure you get it back to BGN. All right. The lessor believes the equipment will be worth $165,000 and it has a 7-year useful life. There's no guarantee. So one thing that, just to kind of hone your intuition a little bit, is notice that the residual value, the $165,000, is fairly close to the fair value of the equipment, and none of that residual value is guaranteed. Anytime you see that kind of a situation, it's a strong indication that it's going to be an operating lease. So just be aware of that. If there's a large residual value that is not guaranteed, it is very likely going to be an operating lease. No option to purchase, and all those things. All right, so let's provide all lease-related journal entries for 2020 through 2023. Again, we need to evaluate the 5 criteria. So there is no transfer of ownership. There's no purchase option. The lease life is 3 years compared to a 7-year useful life, so we didn't violate that. We're going to evaluate the present value next. And there's nothing that tells us that the asset is worthless. And in fact, if there's a 7-year useful life, we've essentially just already said, well, there's 4 useful years remaining, so there probably is an alternative use at the end of the lease. So all of this suggests that this is probably going to be an operating lease, but we need to make sure by doing the actual present value calculation. So again, we start with calculating the implicit rate in the lease, noting that of course payments are happening at the beginning of each period. Our N is 4. 4 semi-annual periods? Yeah, 4 semi-annual periods. I think before I'd said 3. I'm sorry about that. 4 semi-annual periods. The present value of the asset is $215,000. Again, we take that from the problem. They believe that it has a fair value of $215,000. They are going to receive an $18,000 payment, and they believe the asset's going to be worth $165,000 when they get it back. And so again, 4 semi-annual periods. The present value is the fair value at the time the lease is signed, and again, we're adopting the lessor's perspective here. So when we solve for that, we get a semi-annual yield of 3.08%. 3.08%. So the second step then is to take that information and now solve for the present value of the minimum lease payments. The N and I/Y are the same. The payment, of course, instead of being positive is negative. And the lessee has no obligations at the end of this lease, and so the FV for them from their perspective is 0. And so when we solve for this, we get a present value of $68,839. And so the present value of the minimum lease payments is not more than 90% of the fair value of the right of use asset, and so all indications are that this is an operating lease. All right? So again, using the 5 criteria, this is an operating lease. But we still need this present value calculation because even though it's an operating lease, we still need to apply some time value of money principles to this to the accounting. All right. Just like we had done previously, we do need to amortize the lease liability. Now notice a couple things though. First of all, the third column, I don't say interest expense. Instead, I just use the term interest. And the reason why I do that is because with an operating lease, there is no interest expense. However, we use the inferred interest in order to calculate the amount of amortization we need to assign to the lease liability. So it's just a mechanism. So the interest calculation is a mechanism to understand how we need to amortize the lease liability. Again, I want to be very clear. There is no interest expense with an operating lease, but the inferred interest expense is a mechanism for amortizing the lease liability. And so the other difference between the previous amortization table is that the first payment happens immediately. And since the first payment happens immediately with that first payment, there is no inferred interest, which means there is a dollar for dollar reduction to the lease liability account. After that point in time, then the remainder of the amortization is something just like we've typically seen, where we take it all the way down to the residual value of 0. Again, just trying to highlight that to make sure that you understand what's going on. But I do want to stop there to make sure you understand the amortization table. No interest expense, but we're using the effective interest method in order to determine how we amortize the lease liability or how we reduce the lease liability account. Okay, now this is where most students start to, get their heads hurting a little bit. All right? So, there's no direct way to calculate the interest column in this table. There is no direct way to do it. I'm just going to tell you right now, there's no direct way to do it. What we have done here is we've tried to match the lease expense schedule to the amortization of the lease liability. Notice that the interest dates for the lease liability table are September 1st, 2020, March 1st, 2021, and September 1st, 2021. All right? Now, the reason why we have those dates are because those are the dates of the payments. With the lease expense schedule, notice that the dates are a little bit different, but very, very similar. The first date is September 30th, 2020, which is the day before September 1st, 2020. So the third row in the lease liability schedule or lease liability table coincides with the second row in the lease expense schedule because those two dates match up. And the reason why we're using end of period is because lease expense gets accrued at the end of each period, not at the beginning. And so the slight mismatch is just trying to get you to consistently think about the way that we accrue lease expense. It culminates at the end of each 6-month period, whereas payments happen at the beginning of each 6-month period. So they're slightly different. So essentially what we do is we take that inferred interest amount and we throw it into the lease expense schedule. That's all we're doing, is we're throwing it into it. And so notice the order, 1,565 followed by 1,059 followed by 537. That's exactly the same order that we see in the lease liability table. Again, the dates are one day off, but they do coincide, right? And so again, we're reconciling these two things together. We're using that interest column to connect the lease liability amortization and the lease expense and the amortization of the right of use asset. So again, this interest column, it is a mechanism. We don't have interest expense, it is a mechanism. And so this interest column makes this connection, and it allows us to calculate the amount of amortization that we need to have for the right of use asset in order for three things to happen. That amortization column is calculated because we need three things to happen. One, we need to be able to record the cash payments. Two, we need to be able to record the lease expense correctly. And then three, we need to make sure that we amortize the lease liability using the effective interest method. So the amortization of the right of use asset allows that to happen using this lease expense schedule. Again, I cannot highlight enough that this amortization is just this connection of the interest to the amortization of the right of use asset. It's just a mechanism that allows the accounting to work. The intuition on it is not great. Honestly, it's just a matter of the FASB wanted to be able to offer a lease expense sort of accounting, but they wanted to force companies to still have an asset and liability on their books. And so that's what sort of created this situation. But I'm going to stop there for a second because for most students, the lease expense schedule is probably the most difficult thing to understand in all of lease accounting. Okay, so now we're going to use these two tables and we're going to apply them to the problem. Yeah, Jason, I know. Oh, and we need to, so Harry, and you need to be able to amortize the lease liability using the effective interest method. So that's what this lease expense schedule allows to happen. Again, I'm trying to take my time because I know how difficult this table is to understand. Okay, let's try to apply them and maybe that'll help a little bit. All right, so the initial journal entry, this does not change. Whether it is an operating lease or whether it is a finance lease, the initial entry is exactly the same. You debit the right of use piece of equipment for the present value of the minimum lease payments, and you do the same thing for the lease liability, the present value of the minimum lease payments. Now in this case there is an immediate payment, and that immediate payment goes as a reduction to the lease liability, and of course it is a credit to cash. Again, this is going all the way back to this table right here. That's the March 1st, 2020 payment is a dollar for dollar amortization, which is the reduction to the liability account. 18,000, 18,000. All right, now, This is the journal entry where students are like, huh? What is going on here? All right, so now we have the next payment. Now, technically speaking, we would have accrued the lease expense on 8/30/2020. But as I've said already, we only make adjusting entries at the end of a fiscal period. And so because we're not making monthly adjusting entries, we're waiting until September 1st, 2020 to record the lease expense. All right? Again, that's why. So let's talk about all these different pieces. All right? We're going to be going back and forth between the table and what we see here, but you can see that the lease liability has a debit of $16,435. The lease expense has a debit of $18,000. And then we can see those exact amounts reflected in the right of use equipment and the cash. So now let's go back to the tables and see where these numbers came from. We're going to start with the lease liability and the cash. So if we look at the 9/1/2020 row, which is that third row, we can see that the cash payment is $18,000 and the amortization of the lease liability is $16,435. That's where those two amounts came from. We took them directly from the table. Now you just have to remember that the cash payment is a credit and the amortization of the liability is a debit. You just have to remember that because of course the liability is a credit balance. To reduce a credit balance, you need to debit that account. So that is, you just have to know that. All right. So unfortunately, I can't help you more than you just got to know that. Now the second piece is the lease expense and the right of use piece of equipment. Notice that those amounts are $18,000 and $16,435 as well. So let's go back up to the lease expense schedule. So the row that coincides with September 1st, 2020 is our August 30th, 2020 row, which is the second row. Notice that the lease expense is $18,000, and notice that the amortization of the right of use asset, which is that fourth column, is $16,435. So again, we take these numbers directly off the table and we apply them to the journal entry. So more so than probably anything you've done, you're going to heavily rely on these tables in order to figure out what the journal entries need to look like. Again, the entry to the right of use piece of equipment is the mechanism that allowed us to amortize the lease liability, record the interest expense or the lease expense, and record the cash payment. So that right of use piece of equipment that we calculated in the lease expense schedule, that entry amount was just, it's the mechanism that allows those three things to happen, and they're connected through that inferred interest charge on both tables. Again, complicated, I know, but that is actually the way the standard is right now. Can you remember the difference between why the lease liability is credited to cash and to ROU? So Jason, I wouldn't say it that way. So rather than sort of answering your question directly, because the way you ask the question doesn't make 100% correct. Rather, on 3/1/2020, we needed to amortize the lease liability and record the cash payment. At that particular point in time, no time has passed. So there's no lease expense, and there's no need to amortize the lease or the right of use asset because I'm able to fully amortize the lease liability and record the cash payment without using the right of use piece of equipment account to reconcile everything. On September 1st, 2020, now all that is different, because now time has passed, and so we do have a lease expense that we need to record, and the amount of amortization of the lease liability does not fully capture everything that's going on with the lease expense and cash, and so that's why that right of use piece of equipment gets amortized for that difference. In other words, that's the mechanism that connects the two. So I wouldn't say it the way you said it, but hopefully my explanation got you there. So the amounts would always equal from both tables. Yes, so they have to. So the two tables really work together. They're not independent. And again, the reason why they have to equal out is because they're connected through that interest column. Now, the only thing that would be weird, and I'm not going to do this to you, would be a situation where the cash payment is not even over the life of a lease, then it would get weird. Like if the cash payment was a variable, now the whole thing gets weird. I'm not going to do that to you, but understand if that were to happen, then this whole thing gets really much more complicated. But we're starting simple in this class. Relatively simple, I should say. Okay. All right, so now we do have to worry about the adjusting entry. And so if you thought the September 1st, 2020 entry was a little bit difficult, wait till we walk through the adjusting entry. All right, so a couple things. First of all, time has passed. We understand time has passed. And so since time has passed, I have incurred a lease expense. Again, under an operating lease, that is the expense that we record. And so that's the expense that we incur. And we incur that lease expense using straight line. And so over an entire 6-month period, we would incur an $18,000 lease expense. But of course, 4 months have passed in 2020. So between September 1st, 2020 and December 31st, 2020, we would have incurred a $12,000 lease expense. So that's hopefully part of that part of it you can understand, that that's a continuous process. If I come to a fiscal year end, I need to accrue it. But because I have to accrue the lease expense and there's no cash payment, things get a little bit complicated. All right? So let's kind of go down. That's where that lease liability information. So now we're kind of jumping down to the lease liability. All right? So again, we start with the lease expense. Now we're going to think about how this affects or what's going on with the lease liability. Remember, we're continuing to amortize that lease liability using the effective interest method. Now, for this March 1st, 2021 row, part of that row occurs in 2020, and part of that row occurs in 2021. All right, so it's sort of partially in between both. And so we have to focus on that row and say, well, how much of that row occurs in 2020? 4 months, the September, October, November, December. 4 months occur in 2020. And the remaining 2 months occur in 2021. So it's 4, 6, 2, 6. So let's kind of use that information to think about what we need to do. And so remember, with the lease liability, there is no actual payment. Now, here's the thing. We still infer that there is interest that's being accrued to the lease liability account. It's not an interest expense, but the process of amortization requires that we still infer that the interest process is taking place. It's kind of complicated to think about, but that's the idea here. And so this interest process is increasing the lease liability, right? A full amount of interest, if it had been a full 6 months, would be $1,059. But only 4 months of that has accrued in 2020. Again, I want to be clear though, it's not like there's an interest expense. We're just using the interest process to increase the lease liability by a proportional amount. And so the lease liability increases by $706. So then we jump down to the lease expense schedule. Notice that on the lease expense schedule, this 2/28/2021 partially occurs in 2020 and partially occurs in 2021. And what I want to focus on is the amortization row. Amortization column. So notice that over that 6-month period, we need to amortize the right-of-use asset a total of $16,941. 4 months of that occurs in 2020, and 2 months of that occurs in 2021. So what does that mean? So that means we need to amortize 4/6 of that total amount in 2020. And it just so happens that when I do that, it cinches up the journal entry. But again, I want you to understand it had to. It absolutely had to, because the amortization of the right-of-use piece of equipment, again, allows 3 things to happen. It allows us to record the lease expense on a straight-line basis, which is what we've done. It allows us to amortize the lease liability using the effective interest method, which it has done. And it allows us to correctly record cash payments. Now, in this case, there is no cash payment, so I don't have to worry about that third thing, but I still need to do those first 2 things. And so this amortization that I calculated, it allowed those two things to happen. Again, it's going back to that lease expense schedule, and that lease expense schedule created the mechanism for all of this to work. And so again, I know you're going to need to go through this slowly again later, but again, that amortization of the right-of-use piece of equipment, it is a mechanism that allows the lease expense to be recorded, the lease liability to be amortized using the effective interest method, and it allows, when they come, the cash payments to be recorded. All right, so that is the adjusting entry for 2020. All right, so now we have the next payment, the March 1st, 2021 payment. Again, what's happening? We continue to incur the lease expense, the remaining $6,000. I hope that part of it is easy. We need to record the cash payment. That's the $18,000. We need to record that. The piece that we've got to figure out, I think that probably is most difficult, is the lease liability entry amount. If you remember, when we did the finance lease, we said that when we had a partial sort of accrue and then a subsequent payment, that the amortization or the reduction to the lease liability reflected two things. It reflected the amortization from the table, and it reflected any interest that we had accrued to that account. We're doing the exact same thing here. If we go back to the table, you can see that the amount of amortization is $16,941, right? And so whenever that payment on 3/1/2021 takes place, we know part of the reduction to the lease liability needs to be that amortization amount. But we also need to get rid of the interest expense that we had previously accrued to the lease liability. And so the total entry amount to the lease liability is the sum of both. It's the $16,941, which came from the table, and the $706 that we had accrued on December 31st, 2020. So again, those are the two things that sort of sum together to give us the entry amount for the lease liability account. And the right-of-use piece of equipment we can take from the tables. Again, we know that following the table, that lease, did I go too far? I didn't go far enough. The lease expense schedule, we know that on 2/28/2021, which coincides with 3/1/2021, the total amortization for the 6 months ending on that date would be $16,941. We had previously amortized $11,294 on December 31st, 2020. So the remaining amount to amortize is the difference between the two, $5,647. So again, I just want to re-emphasize that all of this is based on the tables, but those tables are connecting the three processes that, again, are important to us. It's that the lease expense is recorded evenly throughout the life of the lease, that the lease liability is amortized using the effective interest method, and I can correctly record my cash payments. And so the amortization of the right-of-use asset is the mechanism that allows those three things happen, and they're connected through the way that we handle that inferred interest column. So again, it's just the way that this all works, and I know that it's complicated, and I know it's not easy to follow, but I'm hoping that as you continue to review this part of the lecture, that it'll start to make more sense to you. I will say most students struggle with these journal entries and calculations on the test, and so I'm aware that this is going to be a challenge for you, but hopefully you get a chance to review this enough. Why did you add lease liability? Oh, so remember, we need to amortize the lease liability following the effective interest method. From the table, we know that the amortization on this date should be $16,941. But we had also previously accrued $706 to the lease liability account from the interest, the inferred interest, at the end of December 31st, 2020. And so that's why we add those two things together. We have to get rid of the amount that we had accrued to the lease liability in December and get rid of the amortization amount that coincides with March 1st, 2021. So there's two components to that journal entry amount. Okay? So now the final journal entry. Again, we're taking two pieces of information, sort of adding it all together. So again, the 9/1/2021 and the 8/30/2000. It's not the final journal entry. I shouldn't have said that. It's the next journal entry. 9/1/2021 coincides with 8/30/2021 in the lease expense schedule. So this should be very similar. It's right from the tables. We record our lease expense, we record our cash payment. They directly offset each other. We know we need to amortize the lease liability using the effective interest method, and when we look at that row in the table, that is directly offset by the amortization of the right-of-use piece of equipment. So this sort of normal journal entry for the payment is fairly straightforward. You take all the amounts right from the tables. Now the one thing I want to highlight, I'm going to go back to it just so you can see it. So notice that with the lease liability, we are at the end of the amortization table, which means we are done with the lease liability as of this date. There's nothing left for us to do with the lease liability. However, notice that we are not done with the lease expense schedule. There is still a lease expense that we will continue to incur, and there's a continuation of the amortization of the right-of-use asset. So those two items will continue even after September 1st, 2021. But the lease liability, we're done with it at this point in time. So then, as we move forward, on December 31st, 2020, we know we need to continue to record the lease expense. There are 4 months that we need to record, so that's where we get the $12,000. And of course, we also need to record 4 months of amortization for the right-of-use piece of equipment. From which table do we take these numbers? All right, so the cash and the lease liability, those amounts always come from the amortization of the lease liability table. The lease expense and the amortization of the right-of-use asset, those both come from the lease expense schedule. Now they're similar, but they're not exactly the same. So again, we accrue 4 months at the end of 2021. We don't have to worry about the liability. So this becomes much simpler. And then finally, on 2/28/2022, we need to record the last 2 months of the lease expense, and that's of course coincided with the amortization of the right-of-use asset. And in this case, the residual value in the lease is 0, and so there's no need to remove the lease liability or the right-of-use asset because the balance in both those accounts is now 0. So we're at the end of the lease chapter. So I want to. It's heavy lifting, I know, especially when we get to that operating lease. It's funny, under the old standard, the operating lease was very easy to handle. Under the new standard, it's incredibly complicated to handle. So they kind of went in the complete opposite direction, which is, I'm sure, fantastic for accounting students. But it will keep you gainfully employed in the future. All right, so are there any questions before we close it up for today, actually for this week? All right, everyone. Well, thank you for paying attention. Thank you for hanging in there. I know, especially with that lease expense schedule, that can get really, really difficult. Again, if you have any questions, feel free to email me. And hopefully you prepare well and continue the great trend that you all started with the last test. Hopefully it continues with this test. I do hope to get a practice test out there in the next few days. I'm kind of reworking this test. I didn't like the way that I had written it for the class in the spring, and so I'm changing it to make it a little more straightforward. So anyway, all that to say, I haven't quite got everything around, but I will in the next few days. All right, everyone. Thank you so much. Take care.